Most people think Wall Street wins because it knows more about the economy. That is not the real edge. The real edge is that big money gets a map before the crowd gets a headline. And when the map says, if the ceasefire holds, buy this, and if the ceasefire breaks, buy that, the crowd is still arguing about what the headline means while the money is already moving. I have spent most of my life watching people confuse information with positioning. They are not the same thing. Information is what you hear. Positioning is what people do with money after they hear it. That difference is where fortunes get made and where small investors get chewed up. I want to tell you something that sounds harsh, because harsh is useful when money is on the line. If you still invest by reacting to the headline in front of you, you are the liquidity. You are the person the better prepared buyer sells to. You are the person the faster seller buys back from. You are not in the game, you are feeding the game. That is why this matters. A large bank does not sit around making emotional guesses about whether the world feels scary. It builds branches. If the ceasefire holds, this group of sectors likely works. If the ceasefire fails, this other group likely works. If the dollar weakens, one basket gets a tailwind. If oil spikes and the conflict spreads, another basket gets protection. That is not prophecy. That is a battlefield map. And most people never build one. They want one story. They want one hero. They want one perfect stock. They want certainty. The market does not pay for certainty. The market pays for being early with a prepared reaction. That is the first rule. The second rule is even more important. When fear gets loud, the opportunity is usually not where the fear is pointing. Fear points at the fire. Money gets made in the exits, in the detours, in the inventory that everybody dumped while staring at the fire. That is what I see in this whole setup. The public hears Middle East, ceasefire, missiles, oil, chaos. The institutional mind asks a colder question. What has already been sold too hard? What is underowned? What will big pools of capital have to chase? If this thing calms down, even a little. That is a very different question, and it leads to a very different portfolio. I want to break this down the way I would explain it to a partner, not the way a salesman explains it to a room. Because if you understand this one structure, you stop investing like a headline addict and start thinking like an allocator. I call the first mechanism the positioning vacuum. This is one of the oldest mechanisms in markets, and it keeps humiliating people because it is too simple for them to respect. When a sector gets hated long enough, under-owned long enough, and sold hard enough, you do not need perfect news for it to move. You only need news that is less bad than feared. That is enough. And the mother of all positioning vacuums right now is big technology. Why? Not because the business has disappeared, not because AI stopped mattering, not because earnings suddenly became irrelevant, but because fear pushed people out of the sector while the underlying earnings machine kept breathing. That is the part people miss. Price can get hated faster than business can deteriorate. And when that gap gets wide enough, the recovery can be violent. In the material I just read, the institutional view was blunt. The S&P 500 could run back towards 7,200 if the calmer scenario holds. The logic behind that is not mystical. It rests on two simple planks. First, earnings season is expected to be solid. Second, technology has already been beaten down hard enough that a lot of money is underexposed and would have to catch up if fear fades. Fay phallocyte fay turn 14 file 0 fay L1 L20 fay phallocyte fay turn 14 file 0 fay L20 L39 fay. That is the vacuum. The market does not need a love story. It needs a gap between ownership and reality. If everybody already owns the thing, even great news can disappoint. If everybody already dumped the thing, merely decent news can create a scramble. I have seen that pattern so many times that I no longer argue with it. I just ask whether the vacuum is large enough to matter. Here it matters. Now let me give you the second mechanism. I call it the leverage snapback. This one sounds technical, but it is really just greed wearing a spreadsheet. Hedge funds do not just use their own money, they borrow on top of it. They shrink that borrowing when they get frightened, and they expand it when the tape stops punishing them. So when you hear that hedge fund leverage has dropped sharply from recent highs, do not treat that like trivia. Treat it like dry powder. Because once those people decide the path is safer, they do not tiptoe back in. They lunge that matters because under-owned technology plus reduced hedge fund leverage is not one tailwind. It is two. You have a sector that many players hate, and you have a class of players that has room to buy aggressively if the macro branch turns constructive. That combination can create moves that look absurd to the unprepared, not because the world became wonderful overnight, because positioning was wrong. This is what amateurs do not understand. The market often rises most when the news still looks ugly. Why? Because the real move is not news-driven, it is inventory-driven. People were in the wrong stuff, or they were not in enough of the right stuff, or they were too hedged, or they were too low on leverage. Then the tape turns just enough, and all the so-called smart money runs through the same narrow door at once. That is why a rally can feel irrational. It is not irrational. It is crowded repair. Third mechanism, I call it the retail echo. This one is dangerous because it flatters people while it traps them. Retail investors like to think they are independent. Usually they are late, usually they sell after the fear has already done most of its damage, then buy back after the move already started. That is not courage. That is emotional latency. And when retail sentiment gets ugly enough, when the crowd has been selling again and again into weakness, you get another source of future fuel. Because if conditions stabilize, those same people stop selling, then some start buying, then some chase. Then leveraged products accelerate the move that does not start the rally. It amplifies it. The material I read laid this out in plain language. Retail sentiment had been terrible, with ordinary investors selling repeatedly into fear. Historically, when positioning becomes this bearish, the next 3 months have often delivered strong returns, with the cited average around 8.2% for the SP 500 and 7% for European stocks. Fay site Fayturn 14 file 0 Fayday 58. L77 Fay. Now, no sane person should treat a historical average like a promise. That is how gamblers talk. But a pattern is still a pattern, and this pattern says that extreme bearish positioning often sets the table for a relief move. Why? Because once enough people have already sold, future selling pressure weakens. And once they begin to doubt their own fear, they become buyers. That is the retail echo. The crowd first deepens the hole, then it helps fill it. Fourth mechanism, I call it the dollar pivot. This matters because currencies quietly decide who gets paid even when nobody is talking about currencies. A lot of people stare at stocks all day and never ask what the dollar is doing. That is like watching a boxing match and ignoring one of the fighters. If the dollar weakens, some assets suddenly breathe easier. Precious metals often like that. Miners often like that even more, because they are leveraged to the thing people are now revaluing. Certain global trades begin to work better. And according to the scenario I just read, one of the favored branches in the constructive case was exactly that. Dollar weakness, then support for precious metals and miners, along with a sequence where smaller caps could move first, then the NASDAQ, then the SP, while discretionary areas such as home builders and retailers plus financials could also benefit. Fay site Fayturn 14 file 0 Fay L77 L100 Fay. That is not a random list. It is a list built around what happens when fear comes out of the system. Small caps respond because they were neglected. The NASDAQ responds because technology was punched too hard. The broader market follows because money broadens out after the first move. Home builders and retailers respond because lower stress changes consumer psychology. Financials respond because a less panicked macro backdrop improves the setup for them too. That is why the map matters. One branch, one chain, one sequence. The crowd asks, what stock should I buy? The professional asks, if branch A unfolds, which sequence of sectors gets repriced first, second, and third? That is a much better question, and asking better questions is one of the biggest edges you can build without being on a trading desk. Now, I want to stop here and make something painfully clear. I am not saying the bullish branch is guaranteed. Anyone who tells you that is either selling confidence or renting it. There is another branch. And if you do not respect the second branch, you are not investing. You are fantasizing. That is the fifth mechanism. I call it the war branch. And this one is brutal. If the ceasefire breaks, if attacks continue, if the region broadens, If Saudi production gets threatened, if the Red Sea and surrounding lanes tighten further, then the whole constructive map flips. Oil goes back up. The dollar strengthens, broad stocks get hit. And in the material I read, even gold and silver were framed as vulnerable in that more acute risk scenario. While the preferred areas shift toward energy, oil services, storage, and pipeline exposure, defense, and fertilizers, airlines become especially exposed if this gets ugly enough. Fay file a site, Fay turn 14 file 0 Fay L100, L121 Fay. That is why I keep telling people to stop looking for one prediction and start building two branches. Because the market does not care whether your opinion was passionate. It cares whether your exposure matched reality. In the calm branch, you want one family of assets. In the war branch, you want a different family. If you mix those up because you wanted one clean narrative, the market will charge you tuition. And it always charges in cash. Let me tell you where ordinary investors get this wrong. They think flexibility means weakness. It is the opposite. Rigidity is weakness. A rigid investor says, I am a tech person, or I am an energy person, or I only buy gold, or I never touch banks. That is identity investing. And identity investing is how people turn a method into a prison. A serious investor has no identity except this one. I go where the odds improve. That is it. Nothing glamorous, nothing ideological, no romance. Just odds. That is the identity flip most people need. You do not need to become a stock picker with swagger. You need to become a scenario allocator with discipline. You do not need a stronger personality. You need a better operating system. And that brings me to the part most people skip, which is why most people stay average. They like analysis. They hate protocol. But analysis without protocol is just entertainment for anxious people. If I were building a simple operating system from this setup, it would look something like this. First, I would stop pretending one headline is enough. A ceasefire headline is not the game. What matters is whether the market starts behaving like it believes the calmer branch. Do technology and growth names stop getting crushed? Do smaller caps start acting alive? Do financials catch a bid? Does the dollar soften? Do precious metals and miners begin acting like liquidity is rotating their way? Do home builder and retail groups stop trading like recession roadkill? If the answers start turning yes, then the branch is telling you something. Second, I would separate what is hated from what is broken. This is one of the most profitable distinctions in the world. Hated assets can be bargains. Broken assets are usually traps. If a business still has earnings power, still has balance sheet integrity, still matters strategically, and it was sold because the macro panic forced people out, that is a very different animal from a weak business that deserved to be destroyed. The crowd always mixes those together. That is why bargains appear. Third, I would watch where forced buying could come from. Not hopeful buying, forced buying. Those are different. Forced buying comes from underweight institutions, from funds with reduced leverage, from people who sold too much, from managers who cannot afford to miss the turn if the branch becomes obvious. That is where powerful moves come from. The biggest rallies are not always built by fresh believers. They are built by trapped skeptics. Fourth, I would write down the war branch in advance, not after it happens, in advance. If conflict resumes, if supply routes stay stressed, if energy tightens further, if the dollar catches a bid, if broad stocks start failing again, then what am I willing to own? What do I refuse to own? Where do I hide? Where do I get paid for the stress instead of subsidizing it? If you do not answer that before the panic, you will answer it emotionally during the panic. And emotional answers are expensive. Fifth, I would stop worshiping the perfect entry. Most people miss big moves because they are obsessed with perfection. They wait for the exact bottom, the exact signal, the exact all clear. Then they discover that the exact all clear comes with higher prices. I have no interest in that game. I would rather be roughly right with a plan than perfectly late without one. That has served me very well. Now I want to press on one deeper point because it is the point beneath all the others. The market is a machine that reprices future probability, not current emotion. Current emotion is loud. Future probability is quiet. When everybody is screaming about the danger of the moment, The repricing often happens in the assets tied to the next step, not the current fear. That is why the public gets confused. They say, how can tech rally when the world still looks messy? Easy, because the market is not paying for your mood, it is paying for the shift in odds. And once the odds shift from catastrophe to merely ugly, huge amounts of capital need new homes. That money does not ask permission from television. It moves. And if you understand the sequence, you move before the commentators explain why the move was obvious. That is the game. I also want to say something about the obsession with expert reports. A report is useful. A report is not a substitute for judgment. You do not win by worshiping the institutional note. You win by extracting the structure from it. That is what I have tried to do here. Not imitate it, not kneel before it, extract the structure. There are only a few pieces that matter, a bullish branch and a bearish branch. A positioning vacuum in technology, a leveraged snapback from institutional players, a retail echo from oversold sentiment, a dollar pivot that can change which sectors breathe easiest, a war branch that flips the whole board. That is enough. You do not need 20 pages of language to act intelligently. You need 5 mechanisms and the discipline to honor them. That is how adults invest. They simplify without becoming simplistic. They hold tension without demanding certainty. They do not need the market to promise them safety. They need the market to offer asymmetry. And there is asymmetry here if the calm branch holds even modestly. The repair in under-owned quality growth and the rotation into the right-linked sectors can be fast. If the war branch reasserts itself, the defensive and conflict-linked exposures become the places that absorb the bid. Either way, there is a map that is the point. The map exists, and the typical retail investor still refuses to draw one. Instead, he asks his favorite poison. He asks, what is the one stock? He asks whether now is a good time. He asks whether the market is manipulated. He asks what some billionaire said on a podcast. All low-value questions. The market rewards high-value questions. Which branch is strengthening? Who is underpositioned? Who will be forced to chase? Which sectors benefit from a weaker dollar? Which sectors survive a stronger one? Where is fear already fully priced? Where is optimism still expensive? Those questions make money. The others mostly fill comment sections. I will give you my own plain language version of the protocol. Now, if the calmer branch strengthens, I want my attention on high-quality growth that was punished too hard, on the parts of the market that benefit when fear drains out, on smaller caps early. If that sequence begins, on the NASDAQ when under-owned technology starts being chased, on financials and selected discretionary areas. If the macro stress comes down, and on precious metals and miners if the dollar weakens and that path opens. If the violent branch reasserts itself, I want to stop pretending hope is a hedge. I want my attention on the areas directly paid by sustained conflict stress: energy, oil-linked infrastructure, defense, fertilizer, and the assets that survive while the broader market absorbs the shock. I want to treat airlines and other highly exposed risk pockets as places to avoid getting cute. That is not a prediction. That is a protocol. And protocol beats prediction more often than ego wants to admit. There is one more thing I want you to understand. The real wealth event in markets is very often not the trend itself. It is the transition between one consensus and the next. That is where people get trapped. That is where the under-owned becomes crowded. That is where the over-owned starts leaking. That is where the investor with a map can act, while the investor with an opinion is still composing a speech. This setup has exactly that feel. Fear got deep, positioning got skewed, capital reduced exposure, and now the tape is trying to answer the only question that matters: was the fear too large for the eventual damage? If the answer is yes, a lot of money is going to move very fast. If the answer is no, a different set of assets gets paid. Either way, somebody gets paid. The only people who should not get paid are the ones who walk into this kind of market with no branch structure at all. Do not be one of them. Do not be the person who waits for the world to feel calm before buying what fear discounted. Do not be the person who buys strength after everyone else already got there. Do not be the person who confuses one clever sentence with a system. And do not be the person who keeps searching for certainty in a business that pays for preparation. I have no desire to sound poetic about this. I want to sound useful. Your job is not to be brave. Your job is not to be loud. Your job is not to predict the exact path of the next missile, the next speech, the next rumor, the next bounce, the next dump. Your job is to know before the next move what belongs to which branch. That is it. Once you do that, the market stops feeling like a casino and starts feeling like a series of probability transfers. One side overreacts, another side gets paid, one group panics, another group rotates, one crowd shouts, another crowd rebalances. That is the whole movie. If you remember nothing else from what I just told you, remember this. Institutions do not always have better brains. They often just have better branches. They do not need to be right about everything. They need to be ready for the thing that matters. And if you learn to build the same kind of branch logic for your own capital, you stop being the audience for market panic and start becoming a participant in market repricing. That is a very different life. And it starts with one uncomfortable admission. You do not need more opinions. You need a map, because the next big move will not wait for you to feel ready. And the market has no mercy for people who arrive after the money already moved.